Let's talk about the broader market here. It's a good opportunity to segue here because just on Tuesday, I think you had a note out saying that there's like warning signs flashing about the markets being overbought. What do you see now at this point? Is this just the beginning?
So I will say, very clearly, I am still in the constructive camp for 2024. We've got a 5,000 target. I'm not sitting here feeling like that's too low at this point in time, though. The big thing that we've seen change since we put our outlook out in mid-November, we did it right before Thanksgiving, is that sentiment has really just done a complete shift. So back at the beginning of November, AAI net bulls were down around 1 standard deviation below the long-term average. That is typically a pretty strong buy signal. And where we are now, last week we hit 1 standard deviation above that long-term average. That typically signals a flat market over the next 3 months and about a 6.5% gain over the next 12 months. So I still think we're going to have a good year, but I do think we just need to sort of have that pause that refreshes. We need to stop and, just take a minute and digest some of these gains, because I do think it's fair to say sentiment's gotten a little too frothy here at the end of the year.
Pause is very different from the kind of pullback that we saw yesterday. Granted, we were up a percent today on the S&P 500. But in terms of the debate around Fed rate cuts, do you think we get clarity on that early next year?
I think we need some clarity. To be honest, it was, I was in Europe last week, so wasn't, sitting there looking at the news every single minute, when that Fed meeting happened. But it really got to the end of the week, and it just felt like too much had been priced too quickly. And I started to see equity investors really start to worry about that late last week and early this week. So it's not that I don't think the cuts are coming. Our team makes a very strong case for why they start in the middle of next year. And if we get more job cuts, right, from big companies like this, that is going to feed that Fed cut narrative. But March, that seems a little too early.
$232 of earnings, and so that gets you a 21-ish multiple, north of 21. But what's the potential pitfall of that 232? I mean, there's a lot baked in. What is earnings growth projections? I think almost 13% for 24.
So the last I saw in the consensus bottom-up estimate was about 245, 246, and I'm at 232. And I'll tell you, that is another source of real interest in my client meetings recently. The big difference between my number and street consensus is I've got kind of flattish margins versus 2022, down a little bit from this year. The bottom-up consensus, not just in, say, staples or tech, just about every single sector in the S&P, massive margin expansion is being anticipated for next year. Now, most of the buy-siders I've been talking to the last couple weeks think the sell-side numbers are too high. They are very sensitive on this margin issue right now, which may be why we're seeing kind of a push to come and say, hey, here's how we're going to, continue to defend those margins. But that's a real source of concern. Like, are these profit margin expectations simply unrealistic on the sell side heading into next year?
Do you want to ask a question or no?
No.
I do have a question. Okay. Because it's the end of the year, and at the end of the year, you tend to be a little bit more reflective on what has passed.
On everything.
On everything. Yeah. But for strategists, I would imagine it's what you got right and what you got wrong. And I think a lot of people got wrong the notion that the economy would be much more resilient, that the consumer would really hang in there, and that we would be here at year end, where we are right now. So how do you take that into consideration as we go into next year? And consensus seems to be all on one side in terms of that soft landing narrative.
So I still think, I've never been in the recession camp. I've never called myself a recessionista. We always thought this was going to be sort of a growth scare, something close to a recession, not quite meeting the definition. And that was sort of a tough call to make back in 2022. I will say what I think we got right this year is sort of recognizing that resiliency was there. I think our valuation model is going to probably end up being right on the year. It's been calling for about 4,700 and a low 20s PE. But, we didn't manage our target properly. We were looking at other things that were more bearish, and so we had a target of 4,250. So clearly not, bullish enough. But, as I look into next year, I think we're still going to have debates over the Fed. I think we're still going to have debates over consumer, and I think that's coming at a time when sentiment is frothy. So those could be triggers and take the market down, for maybe reasons that don't quite pan out later on. But I tell everybody, calls today have 60% conviction level. If you say you have 90 or 100, you're lying. So we're just going to have to be, sort of vigilant as the year goes on.
How do you feel about the broadening out of the market, and maybe even if the broad market doesn't do well, that there could be sectors that really can do well?
So I'm an old small cap strategist, and we pay a lot of attention to that. That is, sort of the destination if a lot of money comes out of this Mag 7 trade, the big cap growth trade. I think the big cap growth trade got crowded and overvalued for good reasons, but there are tactical problems there, and we do need to see some correction. I think that interest rate expectations falling, the Fed fears falling, that was the first leg of this. I think for that to really continue, you need to see economic expectations improve. Growth stocks and big caps typically outperform when GDP is sluggish. GDP is expected to be about 1.2 next year, 1.8 the following year. That is an environment which this growth trade should bounce back. If those numbers are too low, and I think there is a decent chance they are, we may not know that until a little later in the year, then I think you'll see that rotation trade get a second life. But I do think, people like to beat up. I'm answering so many questions on concentration right now in the Mag 7. I can't tell you how many requests we've done for people. They're not bad stocks. They're there for a reason, but we just may need, again, to see that take a little bit of breather, and other parts of the market may deserve to shine for a moment.